All right, everybody, ladies and gentlemen, hello and welcome to us here at Nadex. My name is Philip and I will be your presenter for today's webinar. Today it's the market movers of the 9th of October. We will be looking at the markets together, analyzing what the markets have been doing over the last few days and what they are doing today. I think that's quite a lot to cover. And yeah, just as always, have a look at your webinar interface if you are so kind, and you will see that small questions box, and please put your questions in that box so I know what's on your mind and that I can help you to answer your questions. Although this is more of a market commentary section or webinar today, I'm more than happy to answer your questions concerning the way that I'm reading those charts and so on. And for that reason, please put those questions in that box, and yeah, I do my very best to answer those as we move through the webinar. Right now, I would appreciate a very short yes or why in that box to just let me know that both the audio and the screencast are working properly. And yeah, today's webinar is scheduled to run for around about half an hour. And of course, before we get started, you already see those first risk disclaimers here on the screen. Guys, thank you very much for the feedback. Really appreciate it. It's always good to know that the technicals have been covered. Yeah, have a look at that risk disclaimer here, and essentially this says that trading of course involves risk, and you should understand those risks and the instruments you're using before you're getting active in the market. Neither Trade with Position nor myself are investment advisors, and for that reason nothing that we say should be considered to be actual investment advice. Especially true for the live part of today's webinar. We will be looking at the markets together. It's just I want to show you guys what I'm seeing on those charts. How do I approach the analysis of those charts and those markets? And yeah, looking inside my head. And even if I think that a market might present us with a potential trading opportunity, it's your money that ultimately is on the line. You've worked very hard for that money, and for that reason I know that you must own that trade. You must understand why you think that this is a good trade to take, and not just because some random guy on the internet told you that that setup might be interesting. You must own that trade. You must have a strategy, and you must apply that strategy over and over and over again. So once again, everything's just there for educational purposes. Please make sure you're okay with this before continuing with the webinar. Here is the risk warning from Nadex. Trading on Nadex involves financial risk and may not be appropriate for all investors. The information presented here is for information and educational purposes only and should not be considered an offer or solicitation to buy or sell any financial instrument on Nadex or elsewhere. Any trading decisions that you make are solely your responsibility. Past performance is not necessarily indicative of future results. Nadex contracts are based on underlying asset classes including forex, stock index futures, commodity futures, cryptocurrencies, and economic events. Trading can be volatile and investors risk losing their investment on any given transaction. However, the design of Nadex contracts ensures investors cannot lose more than the cost to enter the transaction. Nadex is subject to US regulatory oversight by the CFTC. That being said, let's have a look at today's agenda. I mentioned that you want to have a trading strategy when it comes to trading the markets. Why? Because your trading should be repeatable. You should have a process by which you can follow. It's just like a pilot in the plane, in the cockpit. He doesn't do a single thing without a checklist, because he knows that if he sticks to his rules, if he sticks to the rules of the plane, everything will go just fine. And he doesn't miss a step. It's just this blueprint, this cookie cutter, and he follows the steps and he gets the results that he's looking for in the long run. Same is true here for trading. We want to have a strategy to apply, and this is how we want to approach those markets. And then when I look at the markets, it's just seeing and checking if the kind of setup that my strategy or my strategies, you don't have to be limited to just one strategy. My idea would be you master one strategy and then you don't move on to the next strategy. You keep on trading that first strategy, but then you try to expand. If that first strategy that you had was for trending markets, maybe you're looking now for a strategy for range-bound markets, and so on. So having a strategy and then just checking the charts that you see, is my strategy applicable in this context, yes or no? And this is what we want to do today. We want to have a look at the markets and understand what the markets have been doing so far. And before we get started, guys, I thought that it might be interesting to kick it off with an analysis of implied volatility. What is implied volatility? Implied volatility is the volatility that is being used for pricing those options in the market, normal plain vanilla call and put options. And a measure for that volatility is the so-called VIX. That's the volatility index published by the Chicago Board of Options Exchange. That's the VIX. People often refer to that index as the fear index. Why? Because if people think that the market is moving rapidly and has a huge potential for further moves, they don't take the historical volatility, they don't use how the market has been behaving in the past, but they anticipate how far that move actually could go. And therefore, without historical volatility changing at all, options suddenly become much more expansive. And the reason for that is implied volatility just has gone up. And what this volatility index, the VIX, actually does is just it recalculates from the current price that you can observe for those options in the market, it recalculates the implied volatility being used to calculate that market. If that implied volatility is high, this usually means people expect that the market can move by quite a bit. And sure enough, if you see what has been going on here in the past, this is a daily chart, not of the VIX, but it's a short-term chart of the VXX, which is a tradable fund, a tradable stock-like paper that you can buy or sell if you want to trade volatility. I've started with this because here you can see, yes, over those last few days, the S&P 500 dropped by quite a bit, much more movement in the market, and for that reason, volatility spiked. Now people, and I've seen this over the last few days very often, especially on YouTube, people say, okay, the VXX is the volatility index, and you just have to zoom out here to just note and see that people have no respect for the market whatsoever. Fear is pretty much at an all-time low, and for that reason, it's just, it's ridiculous how little fear currently is in the market. This statement, this interpretation of that chart is completely wrong. What we want to analyze every time is here the VIX, because this is the volatility index itself. This is the calculated value averaged out. You find the exact formulas and steps to calculate that on the internet if you're looking for. As always, Google is your friend. And if you zoom out here to 2008, 9, 10, you see that the absolute level of fear in the market has been pretty much range bound. This is the fear. This is the implied volatility being used for pricing those options. And right now, we are not at all-time lows. We are somewhat here in this area. And sure enough, that's the recent spike in the market. Yes, the market spiked. But one thing to be absolutely sure of, when people refer to the VXX as the VIX, that's not the same instrument. The VIX is the index that is being calculated. Now, if you want to trade that index, one thing that you can trade are futures, and those futures would be the VX futures. VX would be the ticker symbol or the future contract symbol root for that. And you can see pretty much the same structure as we just saw with the VIX. Now, how can the VXX be so completely different from what we just saw? Those guys running the VXX, they must have some kind of instrument to replicate the type of structure that the VIX currently shows. And they have to adapt and do that every single time when there are changes in the market. And this just means the operators of that fund, the hedge fund or the fund managers, they have to use the VX futures. And because of the term structure of those futures, you have that cost, not cost of carry, you have that rollover effect. Those managers will always have to roll the futures from the current month to the next month, and so on, and so on. And due to the term structure, contango and backwardation are the buzzwords to use here. that's just the type of price structure that you have to see here for the VXX. That's just the cost of rolling that contract. And this just means one thing. The VXX is on the short term somewhat comparable to what the VIX or the VX futures are actually doing. However, due to this rollover, it doesn't make any sense to say, all right, I want to buy this market now because I think long term that market will be going higher. You will always have those reverse splits here in this market. And sure enough, once volatility kicks in, this market spikes up, and this market spikes up very nicely. But overall, the VXX will always trend down due to this effect of rolling the futures. I just found this critical. We are in the options field here, and although Nadex shields away a lot of the complexities here, I've been hearing that story that the VXX is the volatility index so often, and it's just plain wrong. And I want you guys to be aware about what's going on here and why the structure is what it is. On a side note also, here you can see perfectly why I don't like at all, personally, I don't like at all to be short volatility. You think now, all right, if the VXX is always going down like that, why not short that market at any point in time? It makes perfect sense, but please also understand, we were here at a price level of 26, and just a little bit of rumble in the market, and sure enough, prices shot up here to 56. You don't want to have an uncovered short position here or an unhedged short position in any volatility instrument. I like to call this the widow maker. If things go bad, they go bad pretty fast, and you're in a lot of pain and a lot of trouble. So that's just a side note. And yeah, why has volatility spiked over those last few days? Let's have a look at the S&P 500 here, and let's have a look here at the futures. What do we see here on that daily chart? Well, the market has been going higher for a very long time. Let's put it that way. And sure enough, another higher high, higher lows. And now what we're seeing here is another higher low. And the market pushed higher, but what did we get here? We got another, the first lower high. So that was the first warning sign that something doesn't look that good. The market really tried to push, and look at the size of that candle. Let's make it larger. Look at the size of that candle. That candle is not small. The bulls were really at it and were trying to push for higher prices here. And it just looked like a matter of time until the S&P 500 finally would test the 3,000 price level. Didn't happen. Buyers became very reluctant, sellers came in strong, and this is what resulted in the structure of this candle here. You can call it a shooting star. Doesn't matter what the name of that candle is. What matters is that's a very bearish candle, because ultimately the market rejected all this length here of the upper shadow, and even if price had made a new higher high, which it didn't, the structure would still have been pretty bad at that point in time. So next day, market opened, and sure enough, prices started to go down. And that next day, price made a new lower low. That was the previous swing point low, at least on a short-term basis. And sure enough, the next candle took out that low. So now we have a lower high being followed by a lower low. And just once again, you see the size of those candles. Those moves higher here. You always have this this cycle, this changing of small candles and large candles. But if the market goes down, here it went down, bullish candle structure, small candle. Somewhat bearish candle structure, small candle. Bearish candle structure, larger candle, and then we started to turn higher again. Large candle bearish structure, very large candle, and now the market has been going down, and the market has been going down with huge ranges. But the one thing that doesn't fit this big picture here of the perfect storm, of this perfect market going down, and the market is crashing, and the crash is here finally, those long lower shadows. Same explanation, same story as we had here, but this time it's for the bulls, because sure enough, the bears were able to drive price low to this point, but they were not able to sustain that selling momentum. Buyers came in, and sure enough, they were able to drive price back up again to close here. Still, we have a pretty large bearish, pretty large body, and it's a selling body here. But however, the length of this lower shadow shows some good strength in this market. Next candle, pretty much the same story. Yesterday, same story again. Now, pretty much the body becomes smaller and smaller. So this candle here, it's called a hammer. Again, the name is completely irrelevant. What had to happen for that hammer to look the way that it does? The market opened here at this price level, lots of selling going on. Again, it's a large candle, large range. But again, buyers came back and buyers were able to drive this price back up again. And we're sitting here at that level, at that, we're pretty much closed, very close to where the market opened for that day. Very bullish candle structure. Yes, the body is still red, but ultimately that doesn't matter too much, because it's the structure of the candle that is way more important. Next thing, what's going on today? Pretty much the same story, but again, currently that body is again green. So what I'm seeing here is, and just see where the lows of those moves are. You can see, let me try to draw that in. That's the difference between the first move, and you start to see that those candles or those lines are starting to angle. The move lower, yes, it took price lower, but it took price not so low as the previous move took price lower. We are losing momentum here. And sure enough, what we're seeing here today is today's low is higher than that of the previous day. We're starting to see the price is actually starting to turn. And this is what I want to see for this momentum shift. And what I'm seeing here currently is price is pushing higher. It's not a bullish setup, because I want to see a lot of things going for my trade. And on that daily chart, I wouldn't buy this market. We have pushed way beyond our price equilibrium levels identified by the 10 and 20 period moving average. We're sitting now well below those levels. So huge candles, large candles, price is pushing lower. Is there reason to be really worried and thinking the crisis is here? Let's have a look at the weekly chart. And on this weekly chart, you see, no, this is still a perfect uptrend. The uptrend is still intact. And what we have done now is we have just pulled back from a slight overextension from those price equilibrium levels back here into a moving average buy zone. So if you're intending to trade based on the big trend from the weekly chart is pretty much still fine, and everything is pointing there towards higher prices. Or no, let me put it that way. The weekly chart does support looking for further indications that a bullish trade setup might be feasible. Let's put it that way. So weekly chart, nice uptrend, nothing really wrong. And compare it with what we saw here in the beginning of 2018. There was much more noise going on. And so those last moves over those last few days, if you were long, yes, it looked a little bit intimidating and frightening and huge moves. But again, in the big picture, in the big context that we're seeing here, it doesn't really matter that much. It's really just fixing this slight overextension here, which was not terrible at all, and coming back here to price equilibrium levels. Looking at this, I think the market currently might be going higher. No trade setup on the daily chart, but I see momentum upwards on the daily chart. The weekly chart is telling me, yes, this market is still pretty okay to go higher. Nothing convincing, nothing forcing to support a must-see bearish setup here. So why not drop now down with our time frames even further? Let's have a look at the 1 hour chart. and try to identify if we can see something going on there. And let's zoom out here. And you saw this was the recent pullback. And now price is pushing higher. What is it that we see? We can see price on the hourly chart. Price made a higher low. Price is now making a higher high. And now if price might be thinking about pulling back to price equilibrium levels, that might be interesting for a potential long trading opportunity. Let's drop it down to a 15-minute chart. And here we already see this fanning structure in our moving averages. The 10 is above the 20, above the 50. And same story here. I'm looking for a pullback here into my moving average buy zone for a potential buying opportunity. Now, again, this is currently a lower high. So it's not the perfect picture that I had been looking for here. But overall, this is how I approach those markets. I want to understand what is the big picture telling me, what's the weekly chart doing, what's the daily chart doing. And then I'm looking for potential opportunities. And let's have a look at the 5-minute chart. And you can see price dropped down way below here. And since then, rallied higher. Fanning pattern in those moving averages. This is pretty much what we're looking for. We want to see a trending environment. And that trending environment on the 5-minute chart, if we look at the 1-minute chart now, because people sometimes tell me, Philip, you're telling us always about the daily chart, but what's going on those shorter time frames? The same logic applies. Nothing changes at all. I'm still looking at a 10, 20, 50, and 200 period moving average. I'm still using MACD or RSI with my standard box settings to scan for convergence or divergence. The same analysis is true. And let me just zoom out here a little bit. Same story here. Price is shooting higher. Price is pulling back to price equilibrium levels and then is going higher for the next move. Same logic applies if I'm trading a 1-minute chart or if I'm trading a weekly chart. Nadex, of course, with those option contracts and those multiple expiry cycles, is more geared towards those lower time frames. I'm not suggesting that a 1-minute chart is perfect or not. But the hourly chart, or you do have those weekly options available as well, and you pick those time frames where you see the setup and where you feel right at home and feel comfortable about. So that's the S&P 500. I think that market is going higher over those next few at least hours. Is it a perfect uptrend? Not any longer on the daily chart. So yes, we have to be cautious here, but overall, this gloom and doom that has been all over the news I don't see it here. Sure enough, things can happen. I don't have a crystal ball. It's just I want to trade what I see, because that's the only thing that I can trade. I can trade my opinions, but those are just my opinions. And I have to trade what the market is giving me. And in this context, I just had it recently with a trading buddy. Let me just find, here it is, gold. Sure enough, if the market is in trouble, people usually flock towards the safe haven. Safe haven. That's the right way. And sure enough, precious metal, gold, silver, that should be that safe haven. And sure enough, demand should be there, prices should be going higher. So what's going on with gold? Guess what? Gold has been in a very beautiful downtrend just recently. Last few weeks and maybe 1 or 2 months, sideways pattern more or less. But again, we can see, and let's make it larger here again, we can see that those highs actually are falling. We have a series of falling lower highs, not tremendously. It's not that big compression pattern that just screams at me, this market is looking for a breakout to the short side, to the downside. But overall, this market has been under pressure. And over those last few days, where you think people might be getting a little bit scared of the type of price levels that we've seen in the big indices, and they might be looking for that perceived safety from precious metals, No, this is not what the gold futures had been doing. You can see price pretty much stayed in that range. No new higher high, just the same wedge still going on here. And sure enough, yesterday price fell. Doesn't make any sense from a logical, fundamental point of view, at least with the input that I have. But guess what? It doesn't matter, because I'm not trading my opinions. I try to be as objective and as matter of fact as possible. I just look at that chart. Is there a trading setup? No. Is there a clear trend on that market? No, it isn't. Yes, I still have my moving averages in the right order, but guess what? That sideways phase here. Just compare the clear structure that we had here. Clear fanning pattern in those moving averages. Sure enough, price pulled back here from a slight overextension. And what is it that we have here? This green candle. That's again a doji. And yes, the body is green, but that doesn't matter. But ultimately, sellers rejected all this move to the upside. So the perfect trade would have been a sell stop below the low of this candle and just take it from there. This is what I'm looking for. And if I get that setup, I take the trade. Do I see a setup here? No, I don't. It's not a type of breakout trade because I don't see this clear, perfectly defined flat level right now. Let's draw that in. We could shoot for that one here. Very close encounters there, little bit of overshoot there, again very close there. All right, let's assume we want to trade this market here to the downside. What is wrong with that setup? What is wrong with that chart? Any ideas, guys? Just put your answers please into that questions box. And if you have a look at everything that you see here on that chart, what is the one thing where I say, all right, this one fact kills that setup for me at that point in time? Any ideas? Francine, thanks for that answer. It's rejected it several times. That's not the problem, because I think this is how this level actually is defined. And actually, the more often I get a test of this level, the more significant this level becomes. And the idea here is that if I get several touches and all the other things have fallen in line, ultimately, once this level clears, there should be so much pressure in that market, so much more supply in that market for price to actually drop much further below. So just the number of touches here is not the issue, but the real issue is, and Joseph got it best. Thanks for all the answers, guys. We have a loss of momentum here. We have a significant loss of momentum. Just see the absolute level here. First touch of this, let's draw it in. Let's draw it in. All right, we have the first touch here. Where is MACD at that point in time? MACD is here. Where is the second touch? The second touch is there. So what's the value of MACD at that point in time? Right there. Lot of loss of momentum, huge divergence setting up there. So price is shooting here again for a third test of this level. And sure enough, if I combine those points here once again, you see once again divergence as we're approaching here for a third test of this level. I must have convergence. I must see the opportunity that we have convergence on the break, and this is just not happening here. For that reason, I won't take that trade. Why do we have divergence here? Is this just a magical indicator and I just have to put that indicator on my chart in order to see what's going on there? No, not at all. Just compare the speed of the market here and now compare the speed of the market here. Pretty much all sideways movement here. And now for approximately a little bit less time than the market took to drop all this distance here. But just compare those speeds. And sure enough, this drop is what gave us here this huge move to the downside and convergence here on several moves. But since then, these sideways moves, we lost so much momentum, and therefore we have divergence here on that chart. My main takeaway here is indicators are nice. Indicators can help us to see things easier and faster, but we don't need them, because just by eyeballing what price action has been doing here and there, it was obvious that we saw a loss of momentum and that there should be divergence. Guys, if you don't see that right now, that's no issue at all. It just takes a little bit of exercise and practice, and you will see what price action is doing there. Just understand, indicators can never create new information. They are just a transformation of what is already on the chart of price action. And therefore, they can't create new information. They can't create new insights. If you want to master one thing only when it comes to trading, it would be understand to read price action, the size of those candles, the speed of the movement, the ground covered by the move, and so on. All right, guys, time's pretty much up again. And yeah, let's just jump back to those last few slides. We haven't covered the platform today at all. The idea was to look around and see with the S&P 500 if there was something setting up there. Didn't work out this time. Next time for sure. And yeah, have a look around on the Nadex website. Sign up for a demo account. Those demo accounts used to be just for 14 days, but guess what? They are now unlimited. Great benefit. You can really play around and see how easy it is to use the platform and to trade those markets. And yeah, guys, you see the different ways to be in touch here with Nadex in case of any further questions. Joseph, thank you very much for the kind feedback. Really appreciate it. Thank you very much. Yeah, guys, that's it from me for today. That's a wrap. Sign up for other webinars where we cover also the markets again, explain how those different option contracts actually work, and how we can combine those two things. Finding a setup, finding a strategy, and then applying that setup, or applying those Nadex contracts here for that setup. All right, guys. So yeah, thank you very much for tuning in.